Hi, Rob. We're here to talk today about AO World. Their shares are down 30% today. Can you tell me a little bit about the company and what's happened with their shares?
AO World sells appliances, which is an old and traditionally rather low-margin business, but AO World does it online. And so while its margins aren't great, it's growing very quickly, expectations are very high, and today they came out with a trading update that tamped those expectations down. So what they said implies that sales growth for the second half of this fiscal year is going to be about 20%, or maybe a few percentage points higher than that, which is very respectable. However, the street had been looking for something closer to 30%. That difference is enough to whack a third off the company's shares.
So what's changed at the company? Why they've gone from 30% to 20%?
Well, what the company said was that the sales growth they saw a year ago, as it turns out, had a great deal to do with the hype around the company's IPO. So the company essentially got some free advertising from all the media around it at that time, and it's been harder to grow at a similar pace now. I don't buy this explanation. I don't know how you distinguish sales growth that comes from IPO hype from sales growth that doesn't come from IPO hype. What I think is that we have a company attacking a big market in a new way. It's growing quickly, but nobody inside it or outside it really knows what the pattern of that growth going forward is going to be. Expectations got very high, numbers came in lower, and this is what happens.
Okay, so what now for the company?
Well, the stock is still ludicrously richly valued at about 47 times earnings before interest, taxes, depreciation, and amortization. That is a valuation that would make even other internet stocks extremely jealous. So Lex is staying away from these shares because we think even now they price in perfection, and there's a lot of uncertainty in the story now. We don't know what competition is going to be like as this company moves into Europe, which it has to do to live up to its expectations for sales growth. And again, we don't know how much share it's going to ultimately take from bricks and mortar. Stock's still too expensive. Stay away.
All right. Thanks very much.